Hello. As a finance professor who works with aspiring chartered accountants, I see people get really intimidated by the idea of investing all the time. It just seems so complicated, right? But what if I told you there's a tool out there that's specifically designed to make it way, way simpler? Well, in this explainer, we are going to pull back the curtain on one of the best starting points for any new investor, the mutual fund. So let's dive right in.
This is the question that just stops so many people cold. You hear about the market on the news, you know it's important, but when you actually sit down to do it, it's like, where do I even begin? That feeling of being totally overwhelmed is normal, but trust me, it's a wall we're about to knock right down.
So when you're standing at this fork in the road, you've really got two main options. Path number one, you can try to become a stock picker. That means hours and hours of research, trying to find that one company that's going to be a huge winner. Or there's path number two. You can join forces with thousands of other people in what's called a mutual fund. We're going to explore why that second path can be an absolute game changer.
All right, so here's our roadmap. We'll cover what a mutual fund actually is, we'll put it head-to-head against buying stocks, we'll look at the different types out there, break down the biggest advantages, and then wrap up with one key piece of lingo you've got to know.
Okay, let's get right to it. What in the world is a mutual fund, really? Let's just strip away all the fancy financial talk for a second.
I absolutely love this analogy. Think of it like a giant pizza party. If you go it alone, maybe you can only afford one simple slice of cheese pizza. But if you pool your money with a bunch of friends, you can buy a massive pizza with every single topping you can imagine. That's a mutual fund. It's all about pooling small amounts of money to get huge buying power and tons of variety.
And how it works is actually pretty straightforward. It's just a three-step process. First, investors like you put your money into a big pot. Second, a professional, fund manager, takes that big pot of money and invests it for everyone. And third, any of the profits, the returns, get passed right back to you and all the other investors. It's a really clean and efficient system.
You've heard this a million times, right? But I'm telling you, in investing, this isn't just a cute saying. It is the golden rule. It's all about something called diversification. And buying just one stock? Well, that's the very definition of putting all your eggs in one single fragile basket. A mutual fund is designed from the ground up to give you a whole bunch of different baskets right from day one. So let's really put these two strategies side by side. How does buying into one mutual fund really stack up against trying to build your own portfolio of individual stocks all by yourself?
Okay, just look at this breakdown. To get real diversification with individual stocks, you'd probably need to buy into, say, 15 or 20 different companies. That's a huge cost up front, not to mention a massive amount of your time spent on research. A mutual fund, on the other hand, solves all three issues in one go. You get that diversification instantly, it's super affordable to start, and you have a pro doing all the heavy lifting for you.
All right, so the idea makes sense, but then you start looking around and you realize, whoa, there are a ton of different funds out there. So how do you pick? Well, it really just boils down to answering one question about what your main goal is.
And here's the question you need to ask yourself. Am I playing the long game, shooting for growth over many years? Or do I need more stability and maybe some regular income right now? If growth is the name of the game, you're probably looking at equity funds. They invest in stocks. If stability is your top priority, you'll probably lean more towards debt funds, which invest in steadier things like bonds.
But what if you're thinking, I kind of want a little bit of both? Well, you're not alone. And for a lot of people, that's the perfect answer. That's exactly what balanced funds are for. They're designed to give you the best of both worlds, mixing the growth potential of stocks with the stability of bonds, all in one easy package.
Okay, let's do a quick recap of all these powerful benefits we've been talking about. Why should a smart but maybe cautious investor like you really take a serious look at mutual funds?
So let's just run through the big wins here. 1, you get professional management by experts. 2, you get instant diversification, which lowers your risk. 3, you have liquidity, which just means you can get your money out easily if you need to. 4, you get what's called economies of scale, which helps keep the costs low. And finally, number 5, incredible convenience and flexibility. This is where things like systematic investment plans, or SIPs, come in. They let you invest a small, fixed amount automatically every month. It is such a powerful way to build wealth over time without even thinking about it.
All right, we're almost done. I just want to teach you just one piece of financial lingo. It's a 3-letter acronym, and once you get it, you'll know exactly how to track your investment.
And that acronym is NAV, which stands for net asset value. All this is really is the price of one single unit of that fund on a particular day. Think of it like a price tag. It's calculated every day based on the value of all the stocks and bonds the fund owns. But here's the pro tip. Unlike a stock price, a high or low NAV doesn't mean a fund is good or bad. It's just a number. What you want to track is how that NAV changes over time. That's what shows you how your investment is growing.
And just like that, the whole world of mutual funds is suddenly not so complicated, is it? You now have the fundamental knowledge to understand what they are, why they're so powerful, and how they work. So that big question we started with, where do you start? Well, now you have a real answer. The next step is all yours.